contract designated as a fair value hedge of a foreign currency denominated firm commitment to purchase equipment. On November 5th, 2018, our company enters into a firm commitment to purchase equipment for delivery on March 20th, 2019 in euros. The price of the equipment is fixed at €525,000 with payment due on delivery. We're concerned that the US may weaken vis-a-vis the euro, and on the same date, we enter into a foreign currency forward contract with a foreign currency broker to buy €525,000 on March 20th, 2019. We'll pay $1.34 per €1, which is the current forward rate for settlement on March 20th, 2019. We designate the foreign currency forward contract as a fair value hedge of our risk of changes in the fair value of the firm commitment, resulting in changes from the dollar to euro exchange rate. Our company's functional currency is the US dollar. The relevant spot and forward exchange rates during this time period are as follows. Now in this table, with our spot rate, fixed asset purchase transaction, the forward rate, the fair value asset, and the change in fair value. Prepare the journal entries to record the purchase and all adjustments required for the firm commitment, forward contract, and equipment purchase at November 5th, 2018, December 31st, 2018, and March 20th, 2019. So as of 11/5, there's no entry. Again, similar to the previous problem we did like this, the firm must document the hedging relationship and hedge effectiveness in the accounting system. The fair value is equal to 0 at inception, so there's no entry required. On 12/31/18, we are going to have a debit to hedge firm commitment and a credit to depreciation expense. And this is going to be for the $21,000. On March 20th, 2019, we're going to have the same thing, because first we're going to record the change in value. So we're going to have the same accounts, but for the $10,500 this time. Then we need to record the purchase of the fixed assets. So this is going to be your PP&E or some sort of equipment account and a credit to cash. And this was given to us as $672,000. And then finally, we need to reclassify the firm commitment. And so this is going to be a debit to that plant and equipment account and a credit to our hedge firm commitment for the sum of these two previous debits to our hedge firm. And so we have $31,500 there. And we can go ahead and indent all of these credits really quick. For the fair value hedge, same thing. No entry for November 5th. Then on 12/31, we are going to have a debit to depreciation expense and a credit to forward contract, a liability for the $21,000. On 3/20/19, debit to depreciation expense, credit to the forward contract liability for the $10,500 to record the change in value. And then to record the net settlement will be a debit to our forward contract liability, a credit to cash, and that's for the $31,500. Oops. Oh my heavens. B asks us to reconcile the forward rate at the forward contract's inception, the net cash paid for both the equipment purchase and the settlement of the forward contract derivative. So the net cash paid for equipment purchase and settlement of the forward contract derivative is blank. We have our purchase of the equipment and then our settlement of the derivative. And the equipment was $672. The settlement was the $31,500 for a total of $703,500.